September is that key bottleneck. You've got to get through that period. Now you're going to see competing tokenized money market funds, going head to head with, let's say, Tether. What you're really just doing is amplifying the existing bubble. It doesn't have to look like 2008 or 2020 either. It's just we've been trained to brace ourselves for those type of things. You're not going to hear any candidate make these points on the ballot in November, even if Donald Trump was at the Bitcoin conference. I think this IPO with Bold, it's going to be a huge proof point for CIOs out there.
Bitcoin-focused funds have not returned any capital to investors. And so the fact that we're getting these first companies out the door, that's a big thing. This rip of TFTC was brought to you by River. It's the best place to buy Bitcoin. Go to river.com/TFTC and enjoy this episode. Oh, it's just going. We're going, Matt.
Live rip.
Welcome back to the show.
Thanks, Marty. Pleasure to be back with you.
It's been about 16 months since we caught up on this show. As you were saying, deep bear market. Are we still in a bear market? We hit an all-time high earlier this year.
I don't want to jinx anything, but yeah, typically when you start hitting all-time highs, you're not in a bear market anymore. And I think from a technical sense, once you bottom and you're rallying back, you go in phases, right? First phase of a bull market, sentiment is so bad. Like just the masses, the public just still don't see it, while the long-term hodlers, if you will, in Bitcoin, they're accumulating. So they're the first ones to see it, but it's pretty typical in the first wave of a bull market. Sentiment is still really poor. It's following that momentum on the downside versus, well, technically the bottom of the chart was FTX November 2022. So, 400% rally since then. It's kind of hard to say this is still a bear market from a technical sense.
Yeah, we're in this range-bound trading territory between 50 and 65K.
And I think that's actually a really good thing, right? Because if you just think about, markets move in waves as price discovery takes place. If you think about 2022, we had a lot, or 2023, we had a lot of just uninterrupted up moves, right? From that 16K bottom, a little bit of retracement here and there. But this one that's lasted 4 to 5 months, I think this is healthy, just to take some time for, that massive upswing to cool off, all of the short-term, speculators exit out of their positions. And, once again, the people who are highest conviction in the train get to acquire a deeper position. And, the coins ultimately find their stronger hands. And then, assuming we're in a more secular bull wave on top of a more broader or a more broad, overall bull wave, talking about like the 15-year long-term bull market. I view this 4 to 5 month kind of pause as a very healthy just intermittency.
Yeah, we're in the coiling up phase. And the longer it coils, the saying goes, the higher it goes. And I'm seeing some social sentiment indications that that indicate that we're approaching the end of this coiling. And maybe we get down timber and then up October, which has happened historically in most years. But the sentiment is pretty low. I've seen a lot of hardened hodlers that have been in Bitcoin for over a decade, not capitulating, but saying, well, it seems like we can't get out of this morass that we find ourselves in from a price perspective. I find that pretty funny.
It is. It shows you how much is really, despite like logic, the conviction, you've ridden this position through 80, 90% drawdowns. It tells you how important like just the human psyche is to everything going on. That's how the chart materializes. But these are humans engaging in economic activity, and you take 5 months off going nowhere. It's still hard for people, even with all their convictions to I just maintain through even these 4 to 5 month lulls.
Well, I think this is our objective today, Matt. We need to shake these people up and say, hey, slap them. Get yourself together. we've got a big mission here. This is going to be a long journey. We're well along that journey, but it's still going to be a bit longer. Sack up, put your chin up, stop getting all butthurt because the price is range bound for 5 to 6 months.
Coach's halftime speech. Get your troops back and ready for the next wave. But generally, when these things turn, it'll be on some sort of event, right? Like a headline. Like for example, last year, we saw the rates sell off in September, and this is a key time of the calendar, right? September is generally in fixed income, credit, interest rates. September is that key bottleneck. You've got to get through that period, that quarter end, for a lot of reasons, like just structurally. Northern hemisphere is going into fall harvest. That takes a lot of capital. You got to inventory all of that. You also got Q4, which is just for retail consumption. All of your inventory stocking is taking place, and you see this in shipping containers, moving goods from the coast of China to everywhere else in the world. You see things like this year, shipping container rates are just going through another price impulse. After being in a lull from that 2020, 2021, massive impulse. But you see like capital, basically like usage or encumbrance taking place like in Q4. It just sits there for whatever, like just a number of structural reasons. So this September period is a key one to get to. But my point there is generally when you see the pivot or the swing, it's based on like you'll see some sort of catalyst and you'll know like a headline event, something to turn to. So last year, for example, remember we saw a massive interest rate sell-off in treasuries. You saw the high prints on like 10-year, 30-year debt. TLT was in a massive drawdown, et cetera. The swing back actually came, like if you look for headline events, it actually came when you saw it was in Congress when you saw was it Mike Johnson implemented like just a swap and replace and these rotating heads, these figures. I'm trying to remember who was the Speaker of the House before, dangling on to a very slim majority. He got booted, and basically it was like
Kevin McCarthy.
Kevin McCarthy, there we go, with a very tenuous coalition. And you see this actually like a lot of different just governing bodies across U.S., the G7 countries. Europe is going through this as well. You've got these very loose political coalitions that are hanging on for majority control, and things like that is where you see like that headline print, and then you see markets kind of readjust back down and try to find price. So my point there is, yes, we've been in this healthy retracement since I would say March, April is when we hit that all-time high on Bitcoin, if you're looking at that as one of your indicators. But it'll take some sort of catalyst in the macro sense for this to change course. It could be down as well. We don't know for sure. No one has a crystal ball on these things, but this is that time frame. September is that key bottleneck to get through. So as we record this on September 10th, we're gonna hopefully interesting times in front of us.
Yeah, I think that's a big question in many people's minds, particularly those that I was mentioning earlier, who are a bit not disenchanted or disenfranchised, just a bit exhausted from the drawn out bear market. That's one thing I would caution. I bet lingers in the back of their mind. Like if we have a macro sort of event that leads to some sort of broad market, I don't want to say cataclysm, but drawdown.
It doesn't have to look like 2008 or 2020 either. I think everybody is kind of, after those two, we've all lived through them, those massive hits. We're all waiting. It's just kind of like, just we've been trained to brace ourselves for those type of things. But it doesn't have to be, like those types of events. It could be something else, and just the world goes on as it always does. So it doesn't have to be doom and gloom. We're just saying charts pivot, things change on a dime. But on that note, everybody's been building in a bear market. I think we've had 2-3 years to put our work together and put the white pill in place here. I'm tired, like everybody is, I think, in Bitcoin who's been building. But I think we've all made, like, there's going to be a lot of firms who've spent their time wisely, spent their resources wisely through the bear market, and this is just that opportunity to reap the harvest, if you will, in that preparation. So I guess white pill, push through the bull market, and hopefully our hard work will be rewarded.
Agreed. I'm tired as well, but everybody's been working, or a lot of people have been working, and I do think the fruits of that labor will be harvested at some point in the short to medium term, maybe more medium term. But on that note, I mean, you are always one of the most prepared guests. That sends me a list of long notes and topics to talk about. And the first that we're going to jump into today is the state of the Bitcoin-backed credit market, which is something that you have on the ground, boots on the ground, details and intimate knowledge of. So jumping off with a big announcement that was made at the conference in Nashville a couple of months ago, coming from Cantor Fitzgerald, and their facility to support the Bitcoin space, $2 billion. You're saying this is not that much. It's a little toe dip into the market of Bitcoin credit.
I don't want to, drop the lead and say this is not that much as the headline front and center, because in truth, like within the Bitcoin-backed, Bitcoin-secured lending market, this is a massive drop for us. We're a niche of a niche, if you will, within broader global fiat credit markets. But $2 billion, just for equity capital, if you will, like unencumbered, unlevered, et cetera, that's a huge signal, or a huge move as well. Because just speaking from, a firm deploying capital into this industry, the growth that can and will take place. I can't really get across how many more orders of magnitude we have to go here just on the secured lending side of Bitcoin. So 2 billion, massive number in the grand scheme of things in terms of where we are now, but in terms of where we need to get to, this is one of it's one small step for a man, a giant leap for mankind, that kind of thing. But it's a huge signal that we have institutional capital who is taking the Bitcoin secured lending seriously. And I believe over the coming cycle, this is going to be a big part of kind of the interaction and emergence of Bitcoin. You can say Trojan horse, you can say, another analogy, but the integration with global credit markets and, resolving some of the structural problems that are materializing out of that. For example, we can go through the public debt situation, all of that. But yeah, 2 billion is, in context, it's a massive drop for this industry in this space. Just to give a compare and contrast, in the last 4 weeks, we actually had a debt destructuring and a soft default from Ukraine on their international dollar and euro debt. So it was about 18 billion in face value of US dollar bonds and about 2 billion in euro outstanding. The first maturity due that got restructured was due September, I want to say 1st. So it was here in the past week. So this is kind of one of your signposts of, as you're looking at the big macro thing as well, the macro situation. Your financial markets are one of your strongest tells on, how the geopolitics are playing out in the bigger picture. Similar to, World War II. I think Luke Groban does a great job mentioning this. From the Japanese context, you saw, market signals, local industry noticing that, hey, our iron gates are being removed from parks, public facilities, et cetera, being melted down into, war material. And that's kind of your signal that, hey, this, the tops down narrative is telling you we're winning, but the market is telling you maybe something else is taking place. And then on the opposite side of that, on the victory side, you see the Battle of Midway, clearly showing up as a bottom, like an inflection point in the U.S. equity markets. So when you look at the financial tape, you watch the financial headlines, it gives you a sense of where you're actually at in real time. And the key thing I'd want to mention here, I know we're talking about Bitcoin-backed secured lending, but we had 18 billion in US dollar debt. Just soft default and restructure. These, that slug took probably a 60% haircut. It got rolled over into or termed out into, let's say, 2029, 2033, 2034 maturities at sub-market interest rates. So these things have a 1 coupon on them now. They'll step up if the Ukraine economy is able to produce above its IMF targets, through that time period. But in a sense here, those bonds all got essentially taken to the cleaner. And you're looking at Bitcoin secured credit, we're just cheering over 2 billion in. So it tells you how big of a gulf there is, on both sides of the spectrum. These Ukraine bonds, they are not investment grade anymore. They're going to have trouble tapping investment grade markets. On the other side of this, these Bitcoin backed, whole loans that Bill interacts and purchases with through our partners at Unchained, who are, in my opinion, the
gold standard, the Bitcoin standard.
Bitcoin standard of dollar lending, in my opinion, in this space. These Bitcoin-backed loans are fighting to be viewed as secured credit. We're trying to tap in for growing pools of dollar capital. We've got the track record, the prints that are showing that, audited, et cetera. And then on the other side here, you've got the sovereign bonds in default at a big turning point situation, I believe, in the fiscal sense, as well as, where this kind of conflict is going. This is kind of a make or break moment these next 6 to 12 months in terms of whether we ratchet up and escalate from here in this conflict, or, we pull back from the edge. There is some sort of intermittent peace, what have you. But in terms of where these Ukraine bonds price out, they're, if you go on Bloomberg right now, they're trading anywhere between 12 to 16% yield. And these are much more complicated debt instruments than, the standard building block, what the market wants from an Unchained Bitcoin-backed loans. It's a 12-month, 40% LTV at origination, monthly payer, et cetera. So these Ukraine bonds are harder to back out the yield to, or more complex, if you will. There's also that weird option on GDP growth for IMF targets. But those Ukraine bonds are priced within 12 to 16%. And right now, that's kind of our cost of capital. If you want to structure a Bitcoin-backed loan with minimized counterparty risk, over collateralized, like in our view of the world, the lower risk structuring, that's pricing out right now. You can go to Unchained's website. Last I checked, it was originating at a 14% was the cost of capital. So you see those two things. It's like this one piece of sovereign debt that is in a situation with a lot of hair on it, you can get 12 to 16, and then over here 14. It's like, wow, those are apples to apples viewed as the same thing. And the gulf couldn't be wider. And in my opinion, if I'm deploying our firm's balance sheet capital as well as client capital into dollar IOUs, which one actually wins out on a risk reward basis?
This episode was presented by River. River is the best, most secure place to buy Bitcoin in the United States. Go to river.com/TFTC, set up an account today. You'll be able to DCA into Bitcoin without paying any fees. You'll be able to give people Bitcoin via River links. You'll be able to send and receive Bitcoin over the Lightning Network. And you'll be able to set limit orders. If you want to buy Bitcoin at a particular price, below or above where it is now, you can set orders to buy Bitcoin when it hits that price. Go to river.com/TFTC and set up your account today. This episode of TFTC was also brought to you by Bitkey. Bitkey is Bitcoin made easy to use and hard to lose. If you're a hardcore Bitcoiner out there with friends and family members who have not gotten their Bitcoin off exchanges because they're worried about the complexity of hardware wallets, seed phrase backups, this is why Bitkey exists. Bitkey is collaborative custody. You have a ergonomic hardware device with biometric confirmation. You have the Bitkey app with a key in it, and then block holds another key in the server. This doesn't come with any seed phrase backups that people have to secure. You have social backup. It's a beautiful solution. If you're worried about the people in your life that aren't as advanced as you,
in terms of Bitcoin hardware and being able to set that up and secure it, Bitkey is a great first step. So tell them to get a Bitkey. Go to bitkey.world, use the code TFTC20 at checkout, and they'll get 20% off their first Bitkey.
To dig into this and really articulate the point that we're trying to drive home here for anybody listening, just pricing these credit products, Ukraine government bonds, just looking at this as soberly as possible. Ukraine is in the middle of a war with Russia. Their infrastructure and population completely decimated. What is the potential of them getting back on their feet? Hopefully, as you mentioned, we do have some peace. I think depending on the presidential election here in the U.S., it could go one way or the other. But let's just run with the scenario that they do get to peace and they do have the ability to breathe and begin building back their economy. What are the chances that they can overshoot the IMF targets that have been set forth with this restructuring post-war? Like how much shell shock is the economy going to be in? What are the actual prospects of them being able to get themselves up on their feet and rebuild their economy? Some people would argue like maybe it's a good bet because they're building from zero, and so any growth is good growth for them. But still, you have the uncertainty of a war-torn country, and so if you're buying that debt product, there's a lot of risk that comes with it compared to an Unchained, over-collateralized loan. You have Bitcoin in a multi-sig escrow. Nobody has unilateral control over the collateral. It's not being rehypothecated. Bitcoin's the most liquid asset in the world, arguably. You can sell it on a dime if your counterparty does not have enough collateral in the loan at any given point in time, and lo and behold, they're trading at about the same cost of capital, or they had the same cost of capital. And if, like you said, the risk is so mispriced. I mean, we talk about this a lot at 1031 Unchained. Portfolio company we've backed many times, and it's because, I mean, one of the reasons, lending product's just one product, but it shows the sort of forethought that the team at Unchained has in terms of bringing this product to market. It is the most mispriced credit product on the market out of all of them. I would be confident to say. Like the cost of capital for these loans is very high, and when you understand the risk associated with the loan, it is way higher than arguably it should be, which presents an opportunity for funds like Build.
Yeah, and there's actually I guess there's a lack of appreciation for the different walled gardens, if you will, or the distribution channels of where you can access dollar capital. So, for example, we mentioned these, Ukraine sovereign bonds. They're no longer investment grade, right? The largest pool of let's just start with dollar capital here. I'm just focus everything on dollars. It would be the IG rated public bond market, whether you're on FINRA within the domestic U.S. system, or broader, you get into things like SWIFT and other dollar networks, if you will, of how banks communicate with each other. The biggest pool of capital is going to go into your public bond market. And those are what you'll see, like just a debt instrument, trades with a QSIP. You're held to a very high standard on your financial statements. In terms of the metrics you have to hit, across different categories, the ratings agencies, et cetera, have, rubrics. This thing is kind of a known art. We've spent centuries building this up on what your income statement needs to look like, what your balance sheet needs to look like, et cetera, of the metrics you need to hit to issue a public bond, and what the market will digest. But to do that, to really tap that pool of capital, you need to meet all of those criteria as well. But you also need to have a scale. You need to be at least 300 million per bond issue to get into the public tracking indices. So like the Bloomberg US Aggregate Index is the owner of the market share. It's same way S&P has the S&P 500, which pretty much at this point the entire market uses to track US large cap equities. The Dow, no one cares about that but your grandpa. He might have already transitioned to the S&P 500. But point here, if you're going to issue a bond, you need to be at a scale. You need to be at the 300 million threshold to be ag eligible. And so that'll open you up to the investment grade capital. Then you've got bank loans, right? You can do syndication, et cetera, to fund a bank loan, which will typically be middle market or the low end of the large caps, like corporates who can, they're not large enough to issue public bonds, or if they could, they might have like, only one or two, and they don't have enough to build out an issuance curve, if you will. So the market would know where to price their debt. So what they do is they'll maybe tap the bank loan channel and try to syndicate something to raise the dollar capital they need. Then you have like the direct lending and this private credit trend, and these are much smaller markets. Like we're going order of magnitude down here at each one of these. So you go from bank loans to private credit, which is just like bespoke one-off agreements, or sometimes these will be syndicated as well. And you'll get banks and kind of non-bank entities, these private credit firms pooling up to fund a loan. And then you get into things like the high yield market. And then you just keep going down to access funding. And it's like Bitcoin is starting off from nothing, right? This entire thing is bootstrapped on an open protocol, 21 million economic, agents align around that protocol. But we have to eat our way up that entire stack. So to access the big pools of money, like we can't go from, 0 to 100 that fast and get into the game. But we have to start at 0, work our way up. And so the first step is you start with private capital, the high net worths, family offices, et cetera, who are willing to look into and explore what I'd say is like the new frontier of credit and lending, and then you work your way up off of that. So you start with like who will be open to you and actually take this sleeve or this space seriously. And so you just work your way up the stack. But as you can see, like things like Cantor Fitzgerald coming in for a $2 billion injection into this space, we're adding those on, but it's going to take time and proof of work, just like Bitcoin itself is all about. But that's where it comes in. I think it's a good time for us to get together and recap after, was it 16 months? When I first came on TFTC, we were just launching a private fund that our SEC registered investment advisor, Build Asset Management, was going to manage, that would invest specifically a credit fund that invested as its mandate into Bitcoin secured loans. And just through all the due diligence, market exploration process, as we mentioned already, Unchained was the only one at this point we felt comfortable deploying into. And I'd say after 1 year plus, I think we're actually on 14 months of live track record at this point. The proof of work, I'd say we're stacking up really well, apples to apples, against the rest of those opportunities and those credit sleeves I talked about. So some of the highlights, we've maintained 0 non-performing loans, 0 defaults, on the funds holding itself. This is on top of Unchained's track record since it began lending and underwriting Bitcoin backed debt. No loan losses, no non-performing loans, over that time span, well into the 9 figures of originations. And at some point, over the next year, that number is going to cross over, and they're going to hit $1 billion of loan originations with no defaults, no NPLs, which is really unheard of in the rest of the credit space. Like you look at account aging, et cetera. You can follow this across every financial company, every bank. They have to reserve against their bad debt, provision for credit losses, et cetera. So this is somewhere that Unchained really stands out. Bitcoin secured lending really stands out in terms of what it can offer, and why growth is coming, in our opinion, to this area.
Well, let's get back to first principles. Explain why this is the case. Like, why has Unchained been able to issue this product going on 7 years now, with zero loan loss? And then is it a construct of the way they've set up the collateral, the escrow, the LTV ratio? Is it that alone, or is it that in a combination of Unchained's counterparty when you're thinking about the individuals taking out this loan? What is their situation? Why are they doing it in the first place? And are they well positioned to take out these loans?
Yeah, this is going to be kind of a checklist, but I'll try to run through it holistically very quickly. So it starts off with who you lend to. And then I would say it gets into the operations and the risk management. So I'll start off on who you lend to, so client selection. So Unchained as a business actually, starts with a filter on the just the adopters within the. Let's just start with the crypto space, right? If you're crypto bro, you're interested in a Lambo, you're trading ETH, you're trading whatever, all these other tokens, you're not coming to Unchained. That's not their client. Unchained attracts the Bitcoiner who values collaborative custody, some sort of key ownership. They're probably somewhat non-technical. They need assistance, but in general, they're going to be Bitcoin focused. So you start from that first principles, and I kid you not, like that matters a ton, right? From a credit risk, I don't want to deploy dollar capital into someone's secured asset that's funding a Lambo purchase. Like that's just a non-productive use of capital. So you start with who is the client segment that Unchained begins with. So in terms of the kind of major announcement, last December, Unchained had a change of policy to only underwrite Bitcoin-backed loans to commercial borrowers. So you start from there. You did lose a large chunk of what I call the retail market, but in terms of risk management, you actually like lending to a business because what's the difference between a business and individual? Like the individual is financing their consumption needs, savings, et cetera. The business is out there actually to create goods and services in the economy, and they're rewarded for doing so profitably. So these borrowers now have an income statement and a business they're out there building on and delivering real cash flow and value. So you start with that, you check the box. It's like, all right, these guys have they have the asset, they have Bitcoin as their reserve asset on their balance sheet, but then they also have a business to fall back on. And these tend to be, small or middle market kind of entrepreneurs, LLCs, et cetera, who, as we were talking about those tiers of dollar capital to go access, in the market, they may not even be able to work up to getting a bank loan, right? But they might be something like a houser or a housing developer, a rancher. We had a dry cleaner example. These are, entities, people taking on risk in the real economy to, drive profit, manage their business, et cetera. So we like that. And then they have the Bitcoin secured asset on their balance sheet, which we want the borrowers to maintain and grow their Bitcoin stockpile, post that as collateral for an asset. We don't want to see the borrower lose their Bitcoin, get margin called out, et cetera. We'll talk into the Unchained's risk management, what they've built around that is a key ingredient, in my opinion, to why they've had zero NPLs. But we also like the economics incentives that align all parties, because if you really think about it, this business owner does not want to lose their Bitcoin, right? They're heavily incentivized to preserve their business. Like when you get into those adverse credit situations, bottom of the bear market, they don't want to default, lose their business, et cetera. But they also don't want to lose their Bitcoin. So you have those economic incentives really working for you as the lender here, in Build's perspective, deploying dollar capital into this space. I don't know that exists with other assets. So if you think about like posting commercial real estate, right? We can find just like stacks of headlines with, city blocks across the major metros in the U.S. Where you saw a 9-figure CRE loan where the borrowers or the capital group just kind of hand in the keys, take the loss, and turn it over to the bank. And we've got a CRE situation now that needs to be digested and worked through in credit markets. I think in that case, if you're so underwater on your loan, like your value dips so much, like for one, you don't have some of the features of the Bitcoin market to tap into. So that dollar liquidity, fast settlement, to move a skyscraper, right, might take months, quarters, years to find a bid. And it may not, and they're all different as well. Like a skyscraper here in Seattle is different from a skyscraper in Austin, is different from every other major metro. They all have different market profiles. So like it's not one to one. Bitcoin is one Bitcoin on an exchange, whether it's in Chicago on the CME or domestically Coinbase, et cetera, trading for dollars, is technically fungible across markets, across locales. So you have a massive liquidity pool to tap into. The downside is the volatility of the asset, and that's where you get the risk management from Unchained, both with segmentation of collateral. So you have one multi-sig vault mapping to each loan, so they do not pool collateral. They do not rehypothecate provably, right? You have keys spread across all agents. And then you have economics and incentives aligned across all agents. And then you have a margin waterfall kind of structured in on different loan to value thresholds, or the inverse of that, collateral to principal, that really protects the dollar capital from taking losses or absorbing losses, but it also protects the borrower, if you will, from that potential liquidation of their Bitcoin, which effectively amounts from their side to selling Bitcoin at the low points of the chart. So you put all those things together. It's the hard way to lend in this place. Your cost of capital is going to be higher because you're not taking shortcuts, taking on undue risk for more profit to pass down kind of lower spreads down to the borrower. But putting all those things together holistically, in our research and opinion, is how Unchained is able to deliver, what they've done. That's truly impressive over the last 7 years and been the market leader. The market, the supply side of dollar capital is just picking up to that. But it takes all of those things. It's not one thing. It's the completion of the entire checklist.
Yeah. And I mean, you and your team at Build that's your reason for being, is going to help raise dollar capital for this particular strategy. Now you have a track record, a relatively short track record at that, but I guess let's jump into that at Build. Having deployed dollars into Unchained's lending desk, what's that been like for you as a credit fund?
Yeah. So we have other lines of business. We have public funds, 401k funds, et cetera, CITs. But in terms of, you're being a capital allocator here, where you see growth and where you see returns, the Bitcoin-backed lending is the highest and best use of capital allocation, if you will. So it's not the only thing we're doing, but if you see kind of where I spend my time, it is heavily tilted towards advocating for this side of the market on the Bitcoin integration into capital markets. But in terms of the highlights here, 1 year proof of work, which we talked about, 0 non-performing loans. We've increased AUM by 75% year on year. Average loan to value sub 30% as of the last kind of check-in. So very conservative. You typically don't see that in asset-based underwriting. And then an 11% plus unlevered net return. So after all fees, before taxes, these loans are generating a return on assets of 11%, which, if you think about, compare this to the banking system, if you will, like U.S. banking system, which is much more bloated, much more cost. You got to pay for buildings, et cetera. You compare that 11 to a good bank on return on assets on the left, just looking at the left-hand side of its balance sheet, where it deploys capital. It has to lever up a lot to do so. And then it's got a lot of fixed costs, tens of thousands of headcount, hundreds of thousands deployed in the industry. You're looking at a return on assets, probably 1.5% average, maybe 2. A good bank might look like 2.5, 3. So you see on highest and best use of capital here, efficiency. We're just starting to see what this kind of emerging sleeve is going to do for the entire system. I think we're still not seeing how much this is going to compound and how big of a difference this is going to make over, years and decades. So 10 years out, 20 years out, et cetera. This is going to change, in my opinion, the entire, structure and profile of capital markets and the system for the better.
Let's dig into that a little bit. Like, how do you see this playing out?
Big turn. So just start with like the yield profile on like a Bitcoin backed loan versus like the bread and butter of the legacy setup, the legacy framework, which is more treasury debt, right? And the thing I don't think people realize is the system needs more treasury debt as the base layer collateral injected into that system to keep it growing, to keep it stable, to keep it solvent. And that comes with downsides, right? You keep, if you just keep issuing treasury debt, you're putting your, domestic economy more and more into the hole on what it owes, in the future on debt service. And the more you do that, like you keep stacking up more and more IOUs that have to go outside of your borders, you're losing control of your own, nation state's unit of account. And that's, it's not even my opinion. This goes beyond, just making conjectures here, like losing control of your own, sovereign unit of account. At the end of the day, these are all just IOUs. That puts you at like a national security risk, right? So you need to bring that back in. You need to solve the debt situation, all of that. Because like looking at these charts, like we could keep doing what we're doing for another 10 years, 20 years. When you hit an accident like a 2008, 2020, those really put you behind the eight ball and they'll set you back. But if we really wanted to, we could keep going like this and like weakening ourselves for years and decades longer. We could find ways to kick the can. But in terms of like eventually paying the piper, right, it's just going to get worse and worse if you keep doing this. So what I'd put here on how this is going to change the system, right? You think about a T-bill, right? Right now they're issuing at 5. Rates are going to come in. We're going to see cuts next week. As more treasury debt is termed out, they need lower rates to lower those interest payments, to lower that debt service cost. But if you just do the math at 5, right, you see like the after-tax return to an investor, right? These are, if you're just looking in the domestic lenders standpoint, you get 5% pre-tax. Let's say you're a high net worth individual, because I'm going to go apples to apples for sources of capital into the Bitcoin backed lending space. And right now it's, we're starting from the addressable part of the market and moving our way upwards towards institutional. But right now it's a high net worth individual or a family office. Your marginal dollar is going to be taxed at a 37% tax rate. So if you just take that 5% treasury, it looks good. Like, hey, I'm getting 5% first time in 10, 15 years. This is great, right? After tax, you're going to be getting somewhere in the 3% net, right? And then you got to pay your cost of inflation, right? Which, if you look at CPI targets, like, we want to average 2. We've already been through the start since 2020. We're not anywhere near 2. Like if you just, you look at this chart of CPI, sometimes I'll post this on Twitter X, and you just look at like Jackson Hole 2020, right? The big announcement was we're going to do average inflation targeting now. We're going to let inflation run hot from time to time, but we're going to average 2. You're nowhere close to averaging 2, right? We need to see at this point, we need to see 0 inflation the rest of this decade to average a 2 from point to point. So you're not going to get 2, right? It's economically infeasible. So even taking a real return of 1% on your treasury allocations after tax, to get to go from your after tax, 3 and change net return, you're going to get inflated above that, and you're not going to see any real return on treasuries. So you're kind of just sitting in treasuries to tread water. Money. Yeah, well, probably. And you're taking on all the risk too of this whole situation. And then on the other side of that, all you're doing just think of this from the U.S. Treasury's balance sheet, and I don't view them as a bad guy. I think the U.S. government, the institutions, everything that our society worked so hard to put in place, we fought wars over to kind of set our own course and make our own destiny. These are things that need to be saved and preserved, in my opinion. I don't want to see these things go through a sovereign debt cycle, collapse, et cetera. I want these things preserved. But my point there is, if you're deploying your dollar capital into treasuries, all you're doing is financing more debt service, more liabilities, right? That 3.75% net that the Treasury has to pay out, that's a liability, that's a cost. They're going to owe you that. And in real return, your best case scenario looks like maybe you're going to tread water. And then you're taking all the downside risk where the economic pressures want to point you, like they want to, the financial repression that's going on where, you run real interest rates hot, you're taking all downside for doing that. So unless you're a bank and you need to, or a financial institution, or you need to tap repo markets like SOFR for overnight or short-term secured lending, it's hard to make the argument, in my opinion. If you're a non-bank institution, you can't, or if you're a non-financial institution, and you can't tap those repo markets that demand the treasuries as collateral, or it could be agency debt, similar, right? It's hard, after you do a stone cold review of the economics here to make that allocation in. So that's the treasury side. Now, if you go into the Bitcoin backed loan side, right now, let's just start from the top. You're issuing at 14%. We said we're able to deliver an 11 net after fees. That's our track record. That's what we've been delivering. You can go to buildbitcoin.com and review this, but these are monthly prints. So you start from 11 net. You're going to be taxed on that. Say the 37% marginal tax rate that your high net worth individual is going to pay. No one likes paying your taxes, but it's kind of like working out or exercise. It's like for some people it's hard to get off the couch, but while you're doing it, you feel great, and afterwards you feel great. And then you have the long-term benefits as well. But my point here is, you're going to pay tax. There's going to be some drag on that fixed income, but that 37%, it's going to amount to about 4%, 4 points, if you will, of carry for the U.S. Treasury. That's a revenue stream. That's not debt service. That's revenue. So you're literally flipping from the Treasury standpoint. If I send you, or if I'm a lender and I deploy into treasuries, that's a negative for the Treasury. They're going to owe 3 to 4 points a year in negative carry at current prevailing market interest rates. If that same lender deploys into the Bitcoin backed loans at this point, the U.S. Treasury is going to carry at 4%, 4 points annually. So it's literally dollar for dollar, like a cancellation of that debt to deploy into this growth space, right? You're essentially deploying into the domestic small and middle market business who has adopted Bitcoin as their balance sheet reserve asset. They're delivering real goods and services into the economy. So you get all of that good externality, solving the inflation problem also, right? Creating more goods and services, responding to incentives, lowering prices, lowering costs, delivering abundance. And you also, from the Treasury's perspective, the public purse, you're swapping, that income, that liability stream. That's a liability on if you had to put together a sovereign balance sheet, which doesn't exist. You can't go show this anywhere, but that is a if you were a business, that'd be an on balance sheet liability versus a 4% positive carry, 4 points carry for no capital, none of your own capital deployed. This is the private sector deploying this. You get 4 points, in carry at current market interest rates, and that cancels out dollar for dollar every incremental kind of increase. And right now we're growing, the public debt by $1 trillion every quarter.
Yep.
And then on the net here, if you're the dollar capital allocator, you're gonna we're delivering 11% pre-tax. Let's call it 7 after tax. Compare that 7 to the 3.75, 3. So you're getting 7 to 8, let's say, to 3 to 4. So you're literally doing 2x better on dollar capital returns in an inflationary environment, right? Where inflation, the pressures are running hot, the debasement on your dollar is lower. So after tax, you're going to compound at, you got 2x the shield, if you will, on real returns for your dollar capital. This one's kind of just like, it's right out there for everyone to see. They're just, I think the missing piece is actually education here, from both sides of the problem. The treasury situation, the structure and incentives of the existing credit system, and then on the other end of the spectrum there, an understanding of Bitcoin, from just first principles. What is Bitcoin? What is the blockchain? How does everything work? All of that, and then the interaction between those two things, and then how the economics play out over time. It is still very early. Like, we're 15 years in on Bitcoin. Realistically, we're maybe 6 to 8 years in, I'd say, in terms of actually educating the financial industry on what's going on. And I mean, this step with Cantor Fitzgerald is massive. It's high signal in terms of there are parties who get it and are seeing where this is going, where the hockey puck's going, if you will. But that is the exception to the overwhelming rule. Like, we still have, if you line up 100 people, I bet maybe 1 to 2 in the financial industry. These things, both the big picture, it's clicking on both sides, the credit system and then Bitcoin itself, and then how those two things are interacting. But 99 of them are still either ignorantly skeptical or asleep at the wheel, or just not taking these things seriously, and doing the review and planning for where this is going. So it is still very early, but these economic forces, these trends, like the math, you can't break. We talk about Bitcoin being mathematical, cryptographic money, that whole element. But balance sheets, income statements, debt, all of that, it's math, just applied over time. And eventually those forces will just compound. And that's where big transitions will take place. But if you just look at the economic profile, the income statement, the balance sheets, et cetera, that's what I see, playing out over, we could talk about Bitcoin cycles 4 years, or, short-term credit cycles 3 to 5 years, but bigger picture, I think those trends just compound upon themselves. And then, once you look up after 10 to 20 years, you're going to see just massive shifts and just structure of financial institutions.
Yeah. It's making me wonder, like, what is that inflection point that really has the light bulb go off in people's minds? And that's when, like, because I remember when I worked at a managed futures fund, we'd have all these funds come pitch us, and they were upstart funds, and it was all back tested data. Like, here is the return profile of our strategy with the back test added, but we actually don't have any live returns. We don't have any actual track record to show you. And the response that we would give all these funds is like, all right, come back to us when you have a track record. Do you think the fact that you guys have begun developing a track record or getting out there, really pressing this message and trying to have people reach this aha moment is having an effect? You're one of the most hardened road warriors I've met in this industry. I know you've been out pounding the pavement. What is the last year? Yeah. Well, you got to be a road warrior in this industry. Yeah. We can do so much from this seat and projecting out, but people really like to shake hands and look somebody else in the eye, and you've been doing a lot of that. So what has that been like? Have you seen any progress in terms of people really waking up to this strategy?
Absolutely. So yeah, you talked about your experience with back tests in the industry. No one's ever shown anyone in a financial industry seat a bad back test. You don't show your ideas that work. You show the ones that look good. It's like, look, I can achieve, these results. I can increase your Sharpe ratios, et cetera. Paper returns, like, maybe good for testing ideas, strategies, but in terms of if you're actually going to deploy capital, you have to put down real money, real proof of work, and just demonstrate sound capital allocation over time, right? It's the same reason Bitcoiners talk about the Lindy effect. You're 15 years in, 99.99, a lot of nines out there on the decimals, network uptime, et cetera. Proof of work. We keep using that term, but it's true. The performance and realized results on that you print, those matter, both in Bitcoin, but then also in the investment management industry. So you don't actually attract outsiders to deploy capital in with a backtest sheet. You can get, hey, that's interesting, or this looks promising, whatever. But the real trades, real capital deployed, skin in the game, that matters. And having the real tape to point to, that's a necessity. It's not a nice to have. It's a must have if you're going out and working your way up. As we talked about those ladders in the credit markets, right? We start with high net worth individuals, family offices. You can draw in capital based on say your prior reputation, your relationships, just people Bitcoin itself has a network of balance sheets and capital to tap into. But then to work your way up, into the stack, like let's say public markets, the definition of public markets is you might be deploying capital to a company that you have no relationship with, whatsoever. So example, like a public bond or like a public QSIP, investment grade, and you see like Apple, Amazon, so like these massive markets, you might as an investor, participating in that offering, you might not have a one-to-one relationship, with anyone there. You just have a broad relationship with, the company as its whole. And the reason that those companies are, Treasury or, other issuers can issue those bonds and tap those massive markets is because they have that, proof of work. They have, public companies, they'll have years and years and years of audited financials. You can go to SEC Edgar, look at their financials, and sometimes those are completely broken, like you can get into Enron situations, et cetera. But it's really that you have to demonstrate that proof of work, like build that trust within capital markets. So you get into the point here as a fund manager trying to attract pooled capital in a kind of a one-to-many framework, right? That's the definition of like a pooled investment fund is you can draw in capital from multiple sources, and then, hey, we pull in pensions, we pull in high net worth offices, we pull in, sovereign wealth funds, what have you. Put all those things together in one vehicle, regulated, et cetera, audited, all of that, and then deploy into Bitcoin-backed loans. You have to have that track record to expand your relationship beyond that Dunbar number of 150. So yeah, the realized tape, the audited prints, those aren't an option. Those are a must-have.
Yeah, and has that helped you as you're going out there and pitching what you guys are doing, particularly with this lending product to build?
I think so, because there is some element. We talked about the education. How do we converge the gap on where the mispricing is right now and where it needs to get? There's some level of education and understanding that needs to take place, and people like you, Park, like all of our friends in Bitcoin are doing and have done an awesome job at. You need that to educate the capital allocators, from first principles. But what hooks them, in my opinion, into taking it seriously and committing to put the time in, because there is a cost. They have to. If you're a CIO of a state level public pension, for example, you have to educate yourself on Bitcoin, and don't forget that these individuals have to have some level of understanding and conviction across all asset classes. So equities, it might be, I have to understand, the U.S. equity market. I have to understand emerging market. I have to understand all these other country level equity markets, stuff like that where to deploy into. They'll have to understand fixed income, just all these different markets. And then you're asking them to spend time to educate themselves on Bitcoin, which I think everybody within the fence posts of like Bitcoin adopters who are going to be listening to this podcast or listen to RHR every week, consume this content. We've already put the work in because we see it, but you have to have a hook to get that CIO and the investment committee, or other individuals, portfolio managers, to take Bitcoin seriously, and identify how they can deploy, from each of their given mandates, and they all might be unique. Some might be an equity portfolio manager, so to them their choice might be: do I buy MicroStrategy and include it in my portfolio? Do I overweight? They have to grapple with things like, well, MicroStrategy technically isn't in these large cap benchmarks. Well, what do I do there? I'm taking benchmark risk. They have to have high level conviction to make that deployment. Same thing in fixed income. Like if you're a fixed income manager, you're like, all right, if I'm investment grade, right now within Bitcoin, there's no ingredients off the shelf for them to get a Bitcoin exposure into a fixed income portfolio, right? There, as I mentioned, there's no public QSIPs that are Bitcoin secured, first lien on the Bitcoin assets. Like they're just not there. The investment graded in the investment grade universe. But from, let's say you're a CIO leading like you're responsible for multi-asset like allocation, across the entire 100% of the portfolio. Like, what are we going to deploy into equities? What do we deploy into fixed income? What do we deploy into private markets? You've got your private market opportunities within, do I invest in Bitcoin itself? Own UTXOs? How do I custody those? Do I deploy into venture equity? Am I going to take the meeting with 1031? Am I going to deploy into private credit, through Build or a Battery, those companies? You've got to get the CIO to take the opportunity seriously, to put in the work. It's going to take a lot of effort from, say the CIO himself, herself, or an investment committee member. Or you're going to have to deploy analyst research to, demonstrate reasonable basis, the soundness for your decision, for this high conviction deployment. And so to be able to get them over that hump to actually take on this decision, you don't necessarily have to have all those prints, a track record, a SEC registered investment advisor, behind, the results, et cetera. But when you have those things lined up, it makes the job a lot easier. And then it also forces recognition where you're compared apples to apples, let's say on these Unchained originated Bitcoin-backed loans. Those are credit. Now I've got to compare that apples to apples with the rest of my fixed income and credit universe, those investments. And that's where you stand out in terms of real performance. Like, this isn't a back test. This isn't, just some numbers an analyst made up where they're only showing you the good ones. It's like, no, this is the live thing. This is real capital at stake. And so you give these individuals in the kind of the seats or with actual decisions to be made with their hands on the wheel. You give them all of these things, the track record, proof of work, everything's in the box of what they can deploy into. You give them that, they'll actually self-select, and the ones who can see a case for deploying into Bitcoin specifically, you got to get them actually to be Bitcoin, not digital assets, which is also another side of the battle. I'd say we're outnumbered right now in terms of this kind of population of decision makers who would deploy specifically into Bitcoin and play within those swim lanes only, and take the high conviction thesis that everything we've seen the last 15 years is actually a Bitcoin story playing out, not a blockchain story, not a digital asset story. I'd say we're probably outnumbered 10-1 in terms of digital assets friendly versus Bitcoin focused, in these seats. So I think it's, kind of, we went through in the earlier example with Unchained, the entire checklist. You need a lot of things to line up. You're looking at the intersection of a few different circles on the Venn diagram, but the proof of work, the track record, same thing for 1031. You all have financials on your funds. You have realized results. The Bitcoin tape, you have 15 years of printed track record. You have a growing CME futures product, still young, still nascent. We can get into that one if you want. But you've got to hand these people the real results to give them the incentive at whatever point it is where they're having that shower thought one night. How do they hit their 8% target, every year to keep their jobs over the long run. You put all those things together, and eventually they'll have that shower, come to conclusion, if you will. Eureka moment where like, oh, I can do this. So yeah, it definitely takes that proof of work.
Yeah, it's I mean, you mentioned it, but we see it too at 1031. I mean, on the venture side, I mean, I think that the hurdles that we have are a condition of just the 2020 to 2022 like venture scene where interest rates went to zero, cash was flush, funds raised a ton of money, deployed, and now they're sitting there and not returning cash to investors. And that's like that venture more broadly, not even just like Bitcoin backed venture, is in this situation where capital's tight because managers are sitting there having not returned cash to investors, and the investors saying, all right, like if you raise another fund, we'll think about re-upping once you deploy cash. And I think we're going to be able to stand out within those vintages at 1031 because the companies in our portfolio have been building. Fold announced that they'll be going public later this year. But to your point, like whether it's on the credit side or the venture side, like these LPs that will be deploying into these funds want to see some material results, a track record, if you will. And that's,
I was going to say, you had Will on, who did an awesome podcast, like exceptional entrepreneur. Fold is a fantastic story. I think this IPO with Fold is actually going to be very significant in terms of the business, the presentation, all of that for this broader allocation into capital market, or just attracting capital into the space. I think that one's huge. And 1031, self-selecting and deploying capital with Will and Fold. I think that story is gonna be a nice tailwind for us. One of many, but that was really good news to see. And now we have a public equity to point to. I haven't seen Fold's financials, so I'm speaking to this as a bit of an outsider. But at this point now, you have a Bitcoin-focused business, and just I presume they're, let's say the income statement, the balance sheet, all of that, it's looking good, right? That's something we didn't have before, was a core business built around Bitcoin. Now you have a public equity, audited financials, quarterly filings, all of that. It's going to be a huge proof point for the markets, for CIOs out there. I know we have MicroStrategy, we have the Bitcoin miners. The miners are a different business. It's a commodity-driven game. It's kind of a layer on top of the utilities and the energy sector, and then Bitcoin itself. It's a hard story to get a CIO from a multi-asset standpoint to really deploy, make a big bet, if you will, in terms of their allocation into just the Bitcoin miners. It's a volatile. I mean, we know this in the space. It's a highly competitive, highly cyclical industry. But if we show a financial services company like Fold has built, with a sound income statement, strong business profile, you've now got something that you never had before. Even with MicroStrategy, MicroStrategy's core business is not Bitcoin. It's front end data analytics and reporting and data warehousing, like that type of thing. And that core business profile is a different beast altogether. Like what you're really deploying into with MicroStrategy at this point is, a Bitcoin, CFO driven strategy. The core business isn't really Bitcoin yet. With Fold, you have both of those two things working together at a small cap level with a lot of tailwind and growth ahead of it to deploy into. So I think the Fold story, we're talking about a 5-month lull and just a retracement during a bull market where sentiment is kind of just waning low. It's dormant, let's say that. But just the Fold IPO announcement, or SPAC announcement, I think that's a huge tailwind, something we should all be extremely excited about. That's not getting the excitement it deserves at this point in the public discourse.
Yeah. Yeah. I mean, we wholeheartedly believe that at 1031. We're very excited for it. And I think more broadly speaking, whether it's Fold via 1031 or the track record that you're building at Build, it highlights, again, it's still very early, 15 years in. But if you think about it, whether it's in the venture space and credit funds within Bitcoin or even newer than the venture, like we're building track records as funds. It's still the early days of track records. I mean, a lot of Bitcoin focused funds have not returned any capital to investors. And so the fact that we're getting these first companies out the door, monetization events, like that's a big thing for developing the track record that will hopefully be a catalyst for the CIOs and different pension funds, endowments, whatever it may be, opening their eyes and saying, okay, we have something to look at. Because with a track record, if you were to just strip away all the details of a particular fund, whether it's a credit fund or VC funds, just put returns on a blank piece of paper and say, hey, if you saw these returns from a credit fund or a venture fund, like, would you be interested in looking at what the strategy is? And like, just the returns alone, money talks, returns talk, are a wedge that opens up a conversation for these institutions that people are looking to have conversations with.
And we're very early in that process, which is something to be really excited about.
Yeah, I'm bullish. With that being said, you mentioned it earlier, and I think it's something we should definitely dive into, is, again, the perception is that you need to take this broad, diversified look at broader crypto. Bitcoin only is still contrarian within the broader digital asset landscape, and there is competition at the credit product level, if you will, between Bitcoin collateralized debt and what we're seeing begin to develop with stablecoins, DeFi, staking, whatever. And so just laying the landscape there and highlighting the differences in the risk profiles of the two different credit products, or the many different credit products that exist between Bitcoin-focused strategies and broader crypto.
Yeah. They're night and day. You just have to dive into the details. So we talked about how Unchained structures a Bitcoin-backed loan. Operationally, the risk management, and then the asset, with Bitcoin backing the loan, everything is really, within the Bitcoin stack itself, right? You get into a connection into the Bitcoin to call it spot US dollars, which are really just deposits, bank deposits, that FX pair of Bitcoin to USD. So you have the market maker counterparty risk involved. And then you have, the actual banking, the US dollars that, Unchained deploys into, that the dollar capital coming from Build and our clients, et cetera, that's pooled. Those dollars are actually bank dollars. They're within the domestic US banking system. There's no leverage applied. It's hard money. It would be the kind of the street term for this. But you look at those three systems that the Unchained model of Bitcoin secured, Bitcoin backed lending kind of derives from. You got those three pieces: Bitcoin itself, the Bitcoin protocol, the market maker, spot USD, and then the banking system, the bank dollars. But the banks themselves aren't having to take any kind of fractional reserve risk by banking, the supply side of dollar capital in, which comes through like the Build channel, or the borrower side, who is getting those bank deposits, those IOUs. There's no leverage created within the banking system, in this model. We're just porting onto those wires, like the Fed wire system, the regulated U.S. banking system. So that's a sound model, if you will. That's as minimized an operationally risk kind of standpoint to build that structure on, in the paradigms of both systems, with minimized counterparty risk. Notice I never said in there we're taking on like the banks are creating leverage, or how are you secure? U.S. we're buying repo, we're repoing, we're increasing leverage in the public side of the system. We're overnight funding, all this crazy stuff, this leverage, that's not there. So you've minimized risk within the context of that system. Now you go into like a stablecoin product or stablecoin lending, where you can talk about these tokenized MMFs that are popping up. You start with Tether. It's like, all right, what is Tether? It's an offshore domiciled entity that is issuing tokenized dollar IOUs, not interest-bearing dollar IOUs. And just map this in this Tether coin, right? It's gonna operate on these altcoin rails, which are themselves, don't offer the security profile that Bitcoin itself does. They're not the same thing. Bitcoin, we've said, provably solves the Byzantine generals problem, which is just the economic coordination problem. You're going to operate on these other rails, which you don't know are, check the boxes on secure. Most of them are doing proof of stake now, all of these other, incentives. So we know there's risk there, right? I don't have to go into that one and dive deep, but there's a centralization risk. You're also trading these dollar IOUs, which are really just levered liabilities on top of a stack of assets, if you will. Like, look at the quarterly attestations that Tether puts out, and the reserves backing all those Tether issuances or token issuances that are outstanding in the market. And I'm not saying anything bad about Tether. It's an extremely impressive business, what they've built up, and there's clearly product market fit there. But at the end of the day, what is it? It's like, all right, we have a pile of assets, and what is 80% of it is U.S. Treasuries. They become one of the biggest growth clients for digesting increased Treasury supply. And then you just lever the Treasury debt and some other reserve. There's some gold in there. There's some Bitcoin. There's some money market paper, et cetera. But at the end of the day, you're just playing within the context of the legacy system, like the credit bubble paradigm, which needs these treasuries to keep financing and levering itself. And then you're just distributing them on these altcoin platforms. And then those Tether IOUs need to find a home in, let's say, just unregulated, wallets, what have you, just globally, like your market now for deploying those dollar IOUs. Like, now you don't have to run through other countries' central banks or down to the studs through the Fed to the BIS to another central bank and deploy to the banking system through to the cross-border capital markets through that channel. Now you've just got one to many. You can launch your stablecoin or your new rails, Solana, Avalanche, whatever, and then just deploy these dollar tokens on it. And just what you're really just doing is amplifying the existing bubble, like that already exists, this treasury problem. You're not solving any of the structural problems, is my opinion. And then on top of that, you're looking at a different kind of risk profile now, where there are all these platforms, and everybody is just kind of, let's say, in the arena. Like, we're going to find out what works, where growth is, whose yield is sound, all of that. And there's some awesome businesses at play. And I'm not saying they're not viable, not valid, et cetera. But there's just a lot of growth out there. But my whole point is, you've added extra hops of risk into the system, right? Or into the infrastructure, into the structure of these hops of credit intermediaries. When you go from treasury to custody, and then forming a balance sheet with Tether issuing dollar IOUs, and then now you're going to do all these other kind of like peer-to-peer lending markets and lever that way. When you send your Bitcoin into those, you're tapping into all these other different hops of risk. And I've seen now comping apples to apples where, from the borrower's perspective, you get pushback saying, well, Unchained is deploying at 14 right now. Why would I not deploy my Bitcoin and borrow with, someone else for 6 or 7? It's like, well, from the supply side of capital, you obviously prefer the 14. And I can go through, all the risk management and the structure here to get the why you want 14, why it's actually not just a better return, but also minimize counterparty risk, minimized altcoin blockchain risk, all of that. So you're going to get rid of all of that, and you're going to have kind of the soundness, the settlement, censorship resistance, all of these things. We call it just like resistance to network attack, all of those things, decentralization. You're going to have those with Bitcoin and deploying through Unchained, and you're going to be inside the U.S. economy, which is like down to the studs of the global dollar system, where the yield actually comes from. At the end of the day, it's the U.S. private sector who has to keep this whole thing afloat, because if the Treasury can't service that debt stockpile, then I mean it just turns into a printing exercise from time to time. So you go down to the studs deploying into Bitcoin by going through Unchained. You're working with the banks, which is just one layer above the Fed, the lender of last resort. We don't need it because Bitcoin is our not lender of last resort, but it's the bedrock of the loan here, along with the commercial borrower themselves, who are highly incentivized not to get liquidated and lose their Bitcoin. But you're going really as operationally tight and robust and ironing out all those risks as you can with kind of the Unchained model and what Build is deployed into, versus going offshore, doing lending, stablecoin tokenization, all of that. You're not fixing the system from the bottoms up, or fixing the economic problem. You're really just adding another layer to a kind of a credit system or credit approach that is struggling, like it's buckling under the pressures. And you're just stacking, like it's like having a broken foundation in your house, and you're like, well, I'm going to put my budget not into fixing the foundation, the cracked foundation. I'm going to add on another, story to my house. And that's the capital allocation decision you made. It's like, well, the decision you made, back in the past to not fix the foundation, your house might look good for a few years, by putting on that extra story, might even increase the value of the house on Redfin and Zillow. But 10 years down the line, 20 years down the line, if you don't fix the foundation, that house is going to have a massive problem, and all of that capital you deployed into it is going to be, proved to have been a misallocation. You should have made a different structural decision there back when you had the chance. So, in my opinion, that's kind of an apt analogy. And you're also seeing this with kind of growth of not just stablecoin lending, but you're now seeing tokenized money market fund launches. So I know this sounds crazy, but there's actually, I believe, product market fit for this with cross-border settlement. But if you think about, like Tether as itself, I mentioned it's a dollar IOU, but it's non-interest bearing. To actually create like an interest-bearing instrument, you're looking at a different kind of regulatory profile. That's where you get into the money market fund, right? Money market funds are priced at $1 daily NAV. When liquidity transactions take place, those just strike at $1. Deploy capital in. All right, your shares come in at $1. You want to redeem, shares come out at $1. And in order to do that, you have to meet certain kind of regulatory guidelines on what these money market mutual funds are allowed to hold. And there's a lot of reform that's taken place in the last 10 to 15 years, ever since the GFC got underway. It really started not with the Lehman collapse. That was when kind of the rot was exposed to the public. With Bear Stearns, that prior spring wasn't the early warning that something was afoot, but it was really the dominoes were set in motion in August of 2007 when a money market fund in France by BNP Paribas that was holding mortgage-backed securities, specific AAA rated tranches of a mortgage-backed security, became illiquid. There was no bid under them, even though the assets may have been money good still. And then the money market funds couldn't price. So my point there is you're seeing money market fund, what would you say, like business development taking place in the stablecoin, altcoin, all of those channels, like as people try to figure out what to build, what's going to work. And it's only time that's going to really prove out which decisions or blueprints were sound and which weren't. But in the last 9 months, like this year, you've seen tokenized money market fund launches from large asset managers who have gotten into the Bitcoin game with the spot ETFs. So Franklin Templeton, one of the, say, 9 investment managers who've gotten behind an ETF. They launched a tokenized money market fund. I forget which alt chain it settles on, but they've launched this token called Bitkey, which has a U.S. domiciled money market fund. Holds mostly it's going to hold treasuries and secured repo, collateralized by more U.S. treasuries. And now this Bitkey token is going to be, you're going to see cross-border settlement of money market fund shares tokenized and issued on these alt-chain rails. It's gotten above 400, 500 million in assets. So you're seeing product traction come into this emerging niche of a space. And you've seen the same thing from BlackRock. They launched one called BIDL, BUIDL, which is British Virgin Islands domiciled. Basically the same concept, just an offshore domicile. They're not quite as large, I don't think, as the kind of the Bitkey platform and what they've gotten off the ground. But it shows you it's an early sign of where this is going, and it's now you're going to see competing tokenized money market funds, going head to head with, let's say, Tether, and all of these dollar IOUs. We're going to try to figure out what works, what's economic, what works best for the dollar capital that's going into supply, to actually own these tokens, if you will, or own, let's say that's be an equity participant or LP and like a fund like Build manages and deploys into Unchained secure loans. These are all going to compete head to head in the realm of dollar IOUs. And I think right now this is so much more complicated than just what everybody in the CIO seat or similar that we talked about in the financial industry has ever had to think about and wrap their heads around in money markets and dollar credit, if you will. So there's, I guess I'd say like it's an exciting time. I'm glad that we're able to compete in this space with the Bitcoin first, the Bitcoin native thesis. And as I've kind of highlighted in my comments before, I think this is actually a better way out of the existing kind of paradigm and the problems we've amassed with a growing stack of debt, IOUs compounding over the long cycle, like building up since 1971, but really getting underway since like the aftermath of World War II. To take the Bitcoin first approach, the Bitcoin native approach, and that solution to the problem, I think that's going to generate the best outcomes for. I'll just speak on behalf of the U.S. and the private sector. What's best for American workers, businesses, is that Bitcoin first approach to this money market problem. And it's also going to be best for the treasury standpoint as well, right? The more collateralization that takes place on Bitcoin, and we shift over those infrastructure and rails to building on Bitcoin first and minimizing risk and building, like, fix the foundation and then build our house on that. I think that puts us in the best situation for, I want to say, like, preserving our democracy isn't the right way to put it. Like, I don't like when you hear those points about pro-clutching the democracy. It's preserving the American experiment and everything that's been built up, the constitutional rule of law, the whole infrastructure that's done so many good things for us for almost 250 years now. But preserving that for future generations. I think Bitcoin is the ticket, and building this credit system, this foundation that gets us there. You're not going to hear any candidate make these points on the ballot in November, even if Donald Trump was at the Bitcoin conference. I still don't think the kind of the tops down perspective gets it yet. It kind of showcased itself in his sign-off comment. He's like, have fun playing with your Bitcoin and your cryptos and all that stuff. I still don't think he and other people around him, those surrounding decision makers, fully grasp kind of the strategic path and opportunities that need to be executed on over the next 10, 20 years to preserve these things and continue to grow this awesome kind of experiment that needs to be saved, that needs to be preserved through history. So I think putting all that together, we're talking about big picture topics here, but this stablecoin, tokenized money market funds, that's the arena we have to compete in. We have to compete. And I think the tools and resources we have Bitcoin itself, the protocol, the UTXOs. We have, a fair amount of capital between, everybody involved in Bitcoin who's advocating for it. But we also have, the hidden resource we all forget about. We have self-selected for, the best and most productive people, in my opinion. And we talked about that from Unchained at the beginning. Who self-selects in to custody their Bitcoin with Unchained? It's not crypto. Focused individual. It's someone with that Bitcoin mindset. So I think maybe closing with the white pill, we've got the resources and I think we've got the economics at our back. We're going to do it.
We are going to do it. You preface it in your notes. It's the tortoise versus the hare, just playing out in real time. These Bitcoin focused strategies, doing it the right way, making sure individuals' money is secure and you have lending practices that actually make sense for both parties versus DeFi and the continuation of the U.S. sovereign debt situation. And we've seen plenty of times for the first 15 years of Bitcoin and broader crypto's history, like those hare strategies typically do blow up at some point or another. Selfishly, I mean, this is our perspective at 1031 too. And you talk about capital allocators and their focus on digital assets versus Bitcoin, specifically 10-1 from just a social signaling perspective. And then you look at capital, it's even more than that. Like capital deployed toward broader crypto VC is probably 100-1 crypto VC to Bitcoin focused VC. And while it can be frustrating to many that are particularly looking to raise funds for their business that they want to build out, selfishly at 1031, we view that as a massive asymmetric opportunity that exists while everybody's focused in DeFi and Web3 and NFTs, whatever it may be. We've got the ability to pick and choose from what we believe are going to be generational businesses. And I think that same mindset, correct me if I'm wrong, probably applies to what you're doing at Build with this focused Bitcoin lending strategy that I think is going to be here for generations to come as we transition to a Bitcoin standard as well.
Absolutely.
Yeah. And we didn't mention it. We had it on the list. I skipped it because I felt like it flowed better to go in the direction that we did. But the partnership with OpenSats, I think we should touch on that to wrap up as well.
Yep. OpenSats and the Human Rights Foundation's Bitcoin Development Fund. So two organizations where the mission is aligned just from a nonprofit-based supporter of free and open source software development and financial sovereignty, from the bottoms up, empowering millions and billions of people, around the globe. My thought was, granted, we're not at the scale that like a BlackRock or nowhere near it could deploy, but in terms of let's say the carry, when you deploy your dollars into the Bitcoin-backed loans, right, as opposed to making a decision to buy treasuries or something else. I already talked about all the other, apples to apples on the income statement, how everything lines up. But what we committed to was it's a 10% of rev share commitment on the management fees associated with fee-paying clients deployed into the Bitcoin-backed loans, right? So our management fees, you've heard 2 and 20 and private equity, venture capital, private credit. Like typically in private markets, this is not a well-kept secret at all. You can look at it on the public financials, but the actual fees that the manager charges against AUM are pretty high. Like it amounts to like 20% or higher, like in net after the fact of the
10-year fund, if you're doing 10% or 2%, excuse me, you add that up, it's like 20% of the AUM.
It's a massive amount, and it's how these businesses, you look at the public businesses like Blackstone, Ares, like you can back it out. It's very high. With Built, like we're a credit fund, and so your return profile is different. Like your target return isn't the high double digits, almost triple digits CAGR of say Bitcoin, or what a venture equity firm deploying into venture might be competing with on the risk return profile. We're extreme. I would consider us the most conservative capital, if you will, in the space. We talked about the net returns we were able to deliver. But with that mindset, kind of my approach to just pricing fees, this isn't a product that gears itself to 2 and 20. It's a fixed rate, value oriented, 1% management fee. That's all we're going to charge. So principal deployed into the Bitcoin backed loans, just for managing a fund, doing all the work, there's real work involved. It's 1% is all that build makes. So we made a commitment, and that's just top line. We got to cover the costs after that. But we made the commitment to OpenSats and HRF's Bitcoin Development Fund to make them a partner, if you will, on 10% of that rev share. So of our 100 bips that Build carries, that has to cover our expenses, keep the lights on. 10% of that is going to go towards funding free and open source software development, and these tools that are really enabling the economics, from the the foundation level that we talked about of all of this economic growth and good things that are coming out of Bitcoin and its innovation. So just to put that in perspective, for every $1 million deployed through Build into Bitcoin backed loans, that's gonna result in an annual drip of $1,000, just split between OpenSats, General Development Fund or General Fund, and the Bitcoin Development Fund from Human Rights Foundation. And you don't need me to shill it. The great work that Matt Odell, Gigi, all of those people are doing at OpenSats, the projects they fund with no strings attached. Same thing with Bitcoin Development Fund and CK at HRF, Alex Gladstein. Everybody knows what they're doing, all the great things. It is an extremely positive story, and I think it puts Bitcoin in perspective on big picture. What we're doing this for, and over the long and medium term, what the world and the landscape is going to look like, and what we're building, all of us are building towards, and what we want to see. But that decision to commit to, an annual donation was something that we wanted to get behind. So now you see a flywheel developing, if you will, and this is what I've thought about for the last 2 years. What do you want to see take into effect and materialize when you're deploying your dollar capital through the credit system? So if you're just deploying into treasuries, right, what do you see from that? You see an increasing public debt. It's $1 trillion a quarter. If you keep doing this, it's just going to keep going up over time. And you see all of the different problems developing within a credit bubble. That entire landscape. Ultimately, right now we're at an inflection point, to bring it home to what we talked about at the beginning with the situation in Ukraine. The hot border that's developing. All these lines of conflict: Israel, Gaza, Southeast Asia, Philippines, Taiwan, China. All of those things. If we keep doing that, keep going down that route, eventually you just keep forcing those. You also see kind of the bottom dropping out, the lower middle class globally struggling. So you keep doing this route on the existing legacy system. What is the world you see? If you just think about how things play out, if you keep deploying capital that way, versus what if you deploy the existing dollar capital into Bitcoin as the core of your system, your foundation? What do you want to see in the world? Well, we're deploying capital into small and middle market businesses within the U.S. Who are delivering goods and services into the economy, small businesses, thriving communities, helping the Treasury's public debt situation, which that just sending them checks isn't enough. I think we do need true reform and people with the right perspective in those seats and taking office in these institutions that we've put so much time and effort over 2 centuries now plus to put in place and defend. But then now you're also you're connecting the flywheel of these bottoms up tools of free and open source technology. So you see all these things playing together. It's taking us towards that bigger picture. Where do we want to be in 50 years when we hand off the reins to our children and grandchildren? I think just putting in place all of these things and connecting those dots and where the capital is going, I think it puts us on track for that. So I know it's a 10% of 1% doesn't sound like a big number, and the scale we're at right now with Build, Unchained, et cetera, just Bitcoin secured lending itself, we're the niche within with niche within a niche of global credit markets, to the point where a $2 billion injection from Cantor Fitzgerald is a massive headline. But you see the tortoise approach. These things will compound over time is my hope and vision. I think everybody else is who's putting their time and energy and resources into the space. And it's ultimately like, what is the world you want to see in 50 years to hand off? And I think all like that decision with OpenSats and HRF are the exact partners we want to deploy to make that happen.
Yeah. It's an incredible trend to see, and the fact that you guys are doing this so early on is highly encouraging. Hopefully it is yet another signal that's sent out to the rest of the market. Like, hey, if you're building a business on this open source protocol, maybe you should support the people that are making sure that it's up and operational. And once you've officially replaced Blackstone as the largest credit fund in the world, that will be some material flows going towards these open source developers. So it's
we have a long hill to climb before we get there, but it's great to have goals.
Big goals. We're gonna win, Matt. We can't wait 15 months before we catch up next. I'm sure we'll have a lot to talk about as after this election and we get into the new year and things begin to inflect and track records get longer and attention begins to pour into the space. So thank you for joining us. Give us an update and keep crushing it, man.
Can I give a sign off? I want to direct some people somewhere.
Yes.
So this Saturday, I know Marty, Parker, Robin Becca from Anchor Watch, Natalie Brunell, Sam Callahan did me and Bill the massive favor. We put on a Bitcoin conference in Missouri in the state capitol, Bitcoin focused education, full day. I think we did a great job.
Incredible job.
But we couldn't have done it without you all. So I wanted to give a public thanks for that. It's been a year. So to follow on that, bring in, new people, new education, new blood, et cetera, into the space, specifically to, build out Bitcoin adoption, into the Midwest, into the breadbasket region. Sam and Natalie are hosting an event this Saturday, September 14th, in St. Louis, the Bitcoin Lunch. You can go to bitcoin-lunch.com, buy your ticket, but it's, low price. So you're going to be into this for less than $100. Full day of Bitcoin education. Bring your friend, bring your mom, bring your dad, bring your relatives, bring your financial advisor to learn about Bitcoin itself and the capital deployment opportunities and approach. I'll be presenting at the lunch, but it's something Build has sponsored and is proud to support Natalie and Sam as they raise their profile within St. Sorry, and do the hard work on the ground. So September 13th, buildbitcoin.com to learn about the private credit fund and all of that, but Bitcoin-lunch to get your ticket, meet Natalie and Sam, first party, meet me. I mean, I'm the low billing on that one, but come ask your questions, think about what to do in the cycle ahead, and how to entrench Bitcoin in the Missouri and surrounding states, local economies. You can use, I think there's a promo code BUILD to get 21% off. But I would much rather, see you there as opposed to, just getting me credit for attribution on the event. So come in and support us. We'd love to see you there.
Get there if you're in the Missouri area, freaks. If you're in St. Louis, don't sell yourself short, Matt. You're a top billing attraction. That's all we got today, freaks. Peace and love.
All right.